If you or someone in your family collects SSI, the government can now see every bank account with their name on it, even the ones they forgot they still own. And a new rule that took effect this April makes that check happen on almost every single case, with no dollar threshold left to protect you. Quick note before we get into it. This is educational, not legal or financial advice. So if any part of your own situation feels uncertain, that is a conversation for the Social Security Administration directly or a benefits professional who can look at your paperwork. Here is the situation in plain terms. Supplemental Security Income, SSI, is the benefit for people who are 65 or older, blind, or disabled, and who have very limited income and resources. It is different from the Social Security retirement check most people think of when they hear Social Security. SSI has always required applicants to report their bank accounts, and the Social Security Administration has always had the legal right to verify those reports. What changed is how often that verification happens, how wide it reaches, and how little room is left for an honest mistake to slide by unnoticed. If you know someone on SSI or you manage the account for a parent or a spouse who receives it, the next few minutes could save that person months of frozen payments over something as small as an account they opened decades ago and forgot existed. Think about how easy it is to end up in exactly this spot. Someone applies for SSI at 66 after a health scare forces them to stop working part-time. 20 years earlier, a family member added them as a joint owner on a small savings account, just in case, and it has sat there quietly ever since with a few $100s in it. Nobody remembers it exists. It never shows up in conversation. It never crosses their mind when they fill out the SSI application, and it certainly does not feel like money that belongs to them. Under the current rules, that account can still count as a resource in full, and it is exactly the kind of account this expanded verification system is built to surface. That is the trap. It is rarely the person trying to cheat the system. It is far more often the person who simply forgot a small account exists and finds out the hard way during a review. Let's talk about where this actually comes from, because none of this is a rumor or a guess. It comes from two official Social Security Administration policy releases. The first is Emergency Message EM-25046, released August 1st, 2025, which expanded a system called Access to Financial Institutions, or AFI, specifically for SSI applicants and recipients age 65 and older. The second is a revision to that same message, EM-25046 REV, released April 27, 2026, which removed the old buffer and extended full financial institution verification to essentially every new SSI claim allowance, every initial claim reopening, and every appeal reversal that establishes initial eligibility. Both of these are documented on SSA's own policy system, and the underlying AFI program itself is described in SSA's Program Operations Manual, specifically Section SI 01140.200, which confirms it is active in all 50 states, the District of Columbia, and the Northern Mariana Islands. This is not a leak. It is not a leaked internal memo. It is public agency policy, published in SSA's own reference system for the people who process these claims every day, and almost nobody who is actually affected by it has ever heard the term. That gap between what the agency has already built into its own internal process and what the average SSI household actually knows about it is exactly the gap this video is here to close. Let me walk you through exactly what changed, what it looks for, and what you need to check this week if this touches your family. Number 1. The old system used to lean heavily on what you reported yourself. If your reported resources looked reasonable, a full bank check did not always trigger. As of the April 2026 revision, that buffer is gone for new claims, reopenings, and appeal reversals. That means a much larger share of SSI cases now get a direct, automated look at their financial accounts before a first check is ever issued, not just at random or when something looks suspicious. Number 2, this system is not limited to the account your benefit gets deposited into. SSA's own description of AFI says it verifies alleged account balances and also detects undisclosed accounts using what it calls geographic searches, and the agency can run up to 10 of these searches per person per review. That means an old savings account at a bank you switched away from 15 years ago, a credit union account you opened for a car loan and never closed, or a certificate of deposit sitting untouched since a relative passed away. All of it is inside the search radius. If it exists under your name or your social security number anywhere near your address history, this system is built to find it. Picture a 70-year-old SSI recipient who reports one checking account with $800 in it, well under the $2,000 limit. If a geographic search turns up a second, forgotten account with $1,500 sitting in it from years ago, the combined total of $2,300 now sits above the resource limit, even though neither account on its own looked like a problem. Now here's where it gets important, because this is the part that trips up honest people more than anyone deliberately hiding money. If you own a bank account jointly with someone who does not receive SSI themselves, SSA's default assumption is that 100% of the money in that account belongs to you, the SSI recipient, even if you never touched a dollar of it. This is written directly into SSA's guidance on checking and savings accounts. So picture this. A mother added her adult son as a joint owner on her account years ago, purely so he could help pay bills if she got sick. He receives SSI himself. That account, in SSA's eyes, now counts as his resource in full, not half, not a fair share, the entire balance, until he can prove otherwise with documentation. Most people find out about this rule only after a letter arrives. Number 3, and this is the number that makes almost everything else on this list dangerous. The SSI resource limit has been frozen at $2,000 for an individual and $3,000 for a couple since 1989. It has never once been adjusted for inflation. $2,000 in 1989 covered a lot more of life's emergencies than $2,000 does today. That means the margin for error, the amount of wiggle room you have before an old forgotten account tips you over the edge, keeps shrinking every single year while prices go up around it. Most people stop paying attention here, but don't, because the next part is the one that actually shows up in federal audit data. SSA's own Office of the Inspector General reviewed a full fiscal year and found that 54,912 SSI recipients had reported financial accounts totaling less than $400. That is not a typo. Tens of thousands of people reporting almost nothing in the bank, in a program specifically built to catch underreporting. The audit's own conclusion was that recipients underreporting their account balances is one of the most significant and recurring sources of payment error in the entire SSI program. That is exactly the population this new verification expansion is designed to catch, and it does not distinguish between someone deliberately hiding money and someone who simply forgot a small dusty savings account still sitting open somewhere. Here's the part they never tell you plainly. When SSA's system flags a balance that pushes your verified resources over the limit, an employee is required to review it before anything happens to your payment. But when your totals stay under the limit, that same level of human double-checking is not required. In other words, the system is built to catch you going over, not to catch itself being wrong. If a forgotten account quietly pushes you a few $100s past the line, there is no built-in second look protecting you from that mistake before consequences start. And the consequences are not gentle. If SSA opens what they call a limited issue workload to investigate a mismatch, you typically get a letter asking for documentation, and if that letter sits unanswered for 30 days, it can result in an automatic finding against you for the period in question, not a warning, an actual finding. If that becomes a confirmed overpayment, SSA sends a formal notice listing the exact amount, the exact months affected, and it becomes money the agency has the legal authority to claw back, sometimes long after you already spent it on rent or medication. Number 4, if a representative payee manages the SSI recipient's benefit, whether that is an adult child, a caregiver, or another trusted person, that payee's own address and identifying details can be pulled into the same geographic searches. If the payee ever combines their own money with the recipient's benefit in one shared account, that commingling can create exactly the kind of confusing financial picture this system is built to flag. If you manage benefits for a parent or a family member, this is not a detail to skim past. Sit down with them this week and make sure the two financial pictures, yours and theirs, stay completely separate on paper, not just in your own head. Number 5. Not every account actually counts against you, and this is the part that gets left out of most of the scary versions of this story. SSA's own guidance on checking and savings accounts lists specific situations where a joint account is not treated as a full resource. If the SSI recipient does not actually have the legal authority to withdraw money from the account, or if a withdrawal requires a third party's permission first, that account can be excluded from the resource count entirely. The catch is that none of this happens automatically. You have to document it in writing, and often with a signed statement from the bank or the other account holder explaining exactly how the account works. Knowing this rule exists before you need it is the difference between a 5-minute phone call to your bank and a months-long dispute with SSA. Number 6. This is not a one-time event that happens only when someone first applies. SSA conducts what it calls periodic redeterminations of non-medical eligibility, which include a fresh look at resources. And depending on how likely your situation is to change, that review can happen roughly every 1 to 6 years. Cases where income or resources are expected to shift get looked at more often, sometimes annually. Cases considered stable get reviewed less frequently. Either way, the account list you have today is not something you check once and forget. It is something that resurfaces on a schedule, whether you remember it or not, and the AFI system runs its geographic searches fresh every single time. Number 7. Alongside the bank verification changes, SSA also updated how it documents emergency and immediate payments under a companion directive called EM-25046, also effective August 1, 2025. That message replaced the old general purpose form technicians used to record emergency advance payments with a new standardized form, the SSA 8102, which now serves as both the receipt and the official written notice for these payments. Why does this matter to you? Because if you or a family member ever needs an emergency payment while a resource question is being sorted out, that new form is what you should expect to receive, and you should keep a copy of it. It becomes your paper trail if a question about that payment ever comes up later during a redetermination. Number 8, and this matters just as much as anything else in this video. The moment a rule like this starts circulating, it becomes bait for scammers. Some seniors are already getting calls from people claiming to be a verification specialist or a compliance officer, offering to pre-clear or protect their accounts from the new check for a fee. Here's the one sentence to remember. There is no fee, no service, and no third party who can shield your accounts from official SSA verification or complete it on your behalf. The legal basis for this comes straight from federal regulation, specifically 20 CFR 416.207, which requires applicants and their deemers to give SSA permission to contact financial institutions as a condition of eligibility. That permission exists only between you and the federal government. Nobody can buy their way around it. And if someone offers to sell you that, hang up, then call SSA yourself at 1-800-772-1213, a number you look up directly at ssa.gov, never one a caller gives you. So here is your one action step for this week, and it takes less than an hour. Sit down and write out a complete list of every single account with your name or your family member's name on it, not just the one the benefit lands in, and then compare the total honestly against the $2,000 or $3,000 limit. If any of those accounts are joint accounts, request a signed statement from the other account holder explaining who the money actually belongs to and how it has historically been used, and keep that documentation on hand before any review ever happens, not after. If you genuinely are not sure whether an old account is still open, call that bank or credit union directly this week and ask, because the entire goal is knowing exactly what this system would find before it ever runs the search. While you are at it, log into your personal My Social Security account at ssa.gov and confirm what SSA currently has on file for you or your family member, since that is the same information a redetermination review starts from. And if a letter ever does arrive asking about a mismatch, do not sit on it. Respond before the deadline printed on the notice, send whatever documentation is requested, and keep a copy of everything you submit. Because a fast, complete response is what keeps a simple mismatch from turning into a formal overpayment finding. If this helped you get a clearer picture of a rule that most retirees have genuinely never heard of, subscribe, because this channel breaks down exactly this kind of quiet policy change in plain English before it shows up as a problem in your mailbox. And next week, we're covering the senior bonus deduction and what it actually means for your 2026 tax return.